Hey everybody, thank you so much for tuning in to another edition of Market Takes. I am Dion Rabouin. Thank you for being with us here on YouTube. We are doing a live stream to kick off the week, talk about everything that's going on in financial markets, the big stories that you all need to be watching out for. If you're interested in the market, if you're interested in the economy, if you're investors, if you got money that's sitting in a savings account somewhere, this impacts you too. So thank you so much for tuning in to Market Takes this morning. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. Look, we have a huge, massive, enormous week this week. We get not only the April jobs report, which is going to come out on Friday. We also get the Fed meeting on Wednesday, meeting actually Tuesday and Wednesday, but Wednesday is the day we get the results from the meeting and Fed Chair Jerome Powell's press conference. So this is going to be a big week, which is going to tell us a lot about what we're in for the rest of the month, likely the rest of the year. We are, I think, going to get a lot of information about the economy and about what to expect in the markets. And I think investors are going to make a lot of decisions based on what we get this week. So definitely a week to tune in and remember this week because I think it's going to be a big one and a very important one. You know, the market action that we saw for the month that just ended in April, I think really tells the tale of why this week is going to be so important. So I want to dive into that a little bit just to kind of explain what we've been seeing so far this year. I think April was a real microcosm of everything that we've seen so far this year and why this upcoming week is going to be so important. So last week of April, as we closed out the first month of the second quarter and the fourth month of the year, a really tough week for stocks, a really tough week for the stock market, and really ended a tough month. You saw last week the Dow down almost 9% for the month of April. That was the worst month since March 2020, and the S&P 500 actually went back into correction territory. As we start the week today, we are still in that correction on the S&P 500. S&P actually just a little bit lower today. So that was actually the worst month of April the market has had since 1970. And we saw the longest weekly losing streak continue last week since September 2020. So again, we're seeing the market very clearly moving in a negative and down direction. Friday, just as a day, the largest one-day loss since June 11th, 2020. None of these are good signs. And the S&P was bad, but the NASDAQ was worse. We saw the NASDAQ down more than 13% in April, the worst month since October 2008, the worst April since 2000. If you are an investor or a market participant with a memory, you know that 2008 and 2000 are not years that we want to be drawing comparisons to. And Friday on the NASDAQ, the worst day since September 3rd, 2020. But we're not just seeing the sell-off in stocks, we're also seeing a sell-off in bonds. We saw the 2-year Treasury yield, those government bonds, the 2-year Treasury yield up 41 basis points for the month of April. Yield's been up for 9 consecutive months. Not only has the yield risen for 9 consecutive months, and remember, as yields rise, prices fall, so that means bond investors are losing money, but it was the biggest jump in the yield since 1994 for a 9-month period. So that's just a huge sell-off for the 2-year Treasury. And we saw a similar thing in the 10-year Treasury. The 2-year rose almost 2% just over these past 9 months, just year to date, excuse me. So just over the first 4 months and a little bit of change that we've seen so far this year. That's a massive, gigantic move. I can't overstate how big a move that is in the 2-year Treasury yield. The 10-year Treasury yield has been up for 5 consecutive months. Year to date, it's up 140 basis points. That's 1.4%. That's just a giant, massive, huge move. But also gold having its worst month since September 2021. So those traditional safe havens, usually when stocks sell off, investors move into bonds, they move into gold, things like that. Those have both done poorly, and investors have been selling out of those, and you're seeing big drops in price there as well. The one thing that did well was the dollar. The WSJ dollar index, which looks at the dollar versus 16 other currencies, that had its best month, rising almost 5% in April. Best month and biggest percentage gain since May 2012, biggest points gain since October 2008. And why that matters is that's the dollar compared to 16 different currencies. So you're seeing the dollar getting stronger, folks moving money into the dollar and out of those foreign currencies across the world and saying, you know what, I want the dollar, I want the global safe haven, I want to move into the world's reserve currency and this very safe asset. Again, telling you all that because I'm getting you ready for what we've got coming this week. This is the live stream. Thank you all for tuning in. We are seeing a massive sell-off in stocks, in bonds, and in gold last month. And we've seen that really for about all of this year, really, and going back into late last year. So again, we're going to be describing and dealing with, we've talked through the market reaction. Now I'm going to talk about why this upcoming week is going to be so important here on Market Takes on the live stream. So what we've got coming this week, like I said, we've got the jobs report, the non-farm payrolls report from the Labor Department. That's coming out on Friday. Before we get that, we will get the end of the two-day meeting by the Federal Reserve on Wednesday. Fed Chair Jerome Powell is going to come out and say, hey, here's what we decided. He'll hold his press conference. We get just the announcement on rate hikes. We are seeing expectations for the Fed to raise rates at twice the normal pace that they do. And we'll find out. I mean, the market has pretty much priced that in almost entirely, but we will get confirmation of that on Wednesday. We'll also hear from the Fed chair who will take us through what he's thinking and what the board is thinking on Wednesday. Sneaky important release this week is the Fed's report on consumer credit, that G19 report. I told you about a month ago to watch out for that report because I thought it was going to tell us a lot about the economy. It did for February. We get the report for March on Friday. Look out for that. I think that's going to be talking to us as well. So let's get into it, right? This week we get the jobs report, the April non-farm payrolls report, which comes out on Friday. I think that's going to be a very big and very important report. For the pace that it tells us about where we are in pace of jobs. Last month we saw another big report, more than 400,000 jobs added to the US economy. This month expectations for a similar number. Do we get that? But also, more importantly, what do average hourly earnings look like? What's the pace of wage increases for folks in the US economy? Because when economists like Fed Chair Jerome Powell, and he's not a trained economist, but he leads the biggest economics institution in the world, probably, that's the Federal Reserve. When economists like that point to things like the increase in average hourly earnings, the increase in wages, and they say, this is looking a little too hot, there's a reason for that. It's wage increases are generally stickier, as in they stick around longer than other increases for inflation. So as some other things like increases in the price that you pay at stores, price that you pay at the pump, rent increases, things like that, those tend to dissipate a little more easily than wage increases, and we're seeing a big pickup there. So when we get this report on Friday, I think all eyes are going to be on average hourly earnings, which we'll find out. That recently has grown at about 5.6% pace, very high, very elevated, but keep in mind that that's not keeping up with the pace of inflation, which is much higher. Again, the hiring pace as well. We'll also get the JOLTS report this week, which an undercover, very important report, but it's delayed by a couple months. So we will get that report this week as well. That's going to tell us how many hires there were, how many people quit their job, but also how many job openings there are. And we've seen a consistent trend of almost 2-to-1 job openings per unemployed person. Does that continue? Because you can't fill all those jobs. And businesses are saying we need workers, and they're hiring, right? But they're not hiring at a pace fast enough for them or to even get us back to the pace of employment that we had before the pandemic hit in March 2020. So we're going to see on Friday what the pace is of job hires, what the pace is of employment gains, as well as what the pace is of those average hourly earnings, what the pace is of wage increases that workers are demanding, and more importantly, that workers are getting. So that's why I think this is going to be a very big report. Again, jobs report is out on Friday. Expectations are that we will add 375,000 jobs in April after 431,000 jobs were added the month before in March. So continued pace of around 400,000 jobs, a strong pace, but not a pace that's going to get us back quickly to recouping those jobs that we had, getting us back to the employment level that we were at in February 2020. And again, as I said, the most important piece of that release, I think, is going to be the average hourly earnings number. Now, all of that matters because it matters to the Federal Reserve. And we hear from the Federal Reserve and Fed Chair Jerome Powell on Wednesday. The Fed has really ratcheted up expectations for the action they're going to take. If you remember, if we rewind to about a year ago, the Federal Reserve was seeing rising inflation because we've seen PCE and CPI, which are the two big inflation reports. They've risen pretty consistently for more than a year. If you look at the PCE, Personal Consumption Expenditures Report, that has risen every single month since December of 2020. And so around then it was going at about 1.6, 1.7. Then we got to 3%, and the Federal Reserve was saying, hey, we think inflation is going to be transitory. We think that it's going to be temporary. All these impacts of supply chains and issues like that are all COVID related. We think this is going to go away naturally. We don't need to raise rates. Then you saw kind of the end of last year, start of this year, the Fed saying, okay, you know what? This isn't going away. We're going to retire that word transitory. We now need to start raising rates. We're going to start doing that as we get into this year. As we've moved into where we are now, in April or in May now, I guess, of 2022, the Federal Reserve is saying, yeah, we're going to have to raise rates and we're going to have to raise them fast. For this upcoming meeting, the expectation is for a 50 basis point rate hike. The Federal Reserve normally raises 25 basis points at a time to kind of let those rate hikes simmer in, let the economy get used to that so you're not overheating things. But now they're saying, look, we are behind on inflation. We need to act fast and act quickly, so we're going to do 50 basis points likely. Fed Chair Jerome Powell will never say this is officially what we're absolutely going to do, but he said we're looking at that, it's on the table. The market has priced that in at over a 99% probability according to the Fed Fund Futures market. So markets have said this is a foregone conclusion. They're going to raise rates 50 basis points. Not only that, the market has said they are going to raise rates at 75 basis points, as in triple the normal pace at the June meeting, and then another 50 basis point increase at the next meeting in July. So the market is saying these 25 basis point rate increases, that's not going to be enough. The Federal Reserve is going to have to go much faster than before, and we will find out. We'll hear from the chairman himself on Wednesday whether he is in agreement with that or whether he says, you know what, pump the brakes. We're not that far behind. We don't need to go that fast. But likely, you know, if he doesn't raise rates at 50 basis points, there's going to be a lot of explaining to do. Markets are probably going to go absolutely crazy. I don't think that's going to happen because this Federal Reserve has been very clear about setting expectations, what they're going to do and keeping to those. So we can likely expect that. But what happens in June? What happens in July? What happens at their next meeting in September? This is going to set the table for all of that, what we hear from the chairman on Wednesday. So that's going to be big. The markets are going to move. Be sure you can count on that. You can set your watch to that. But we'll see just where it goes. You know, we've seen just recently on Friday, the Shadow Open Markets Committee, which is a company or it's a group of folks that watch the Fed. They held a meeting with 3 former presidents of the Federal Reserve, and they pretty uniformly said, we don't think the Fed can slow down the economy without causing a recession. We don't think the Fed can do what needs to be done to tame and rein in inflation without causing a recession. And we'll see. Federal Reserve Chair Jerome Powell may have to push back on that because he and the rest of the Fed have said we can achieve a soft landing, we can bring things in. But we're seeing it right now in things like the mortgage market, right? Where rates are above 5% on an average 30-year fixed rate mortgage, rising pretty well above 5% now. We're seeing this in stores everywhere where we're seeing inflation. And the big question right now is, has inflation peaked? We saw that CPI report for the last month that we got at 8.5%. So right now, year over year, prices are rising at 8.5%. But we started to see signs that that might be peaking and then coming down. If you look at the core PCE report and the core report on that CPI, those showed that the month over month numbers within the core, is that when you take out volatile food and energy prices, you know, because those jump around, they move around a lot. If you strip those out, the core rate of inflation, what you pay for goods, what you pay for rent, things like that, is slowing down and coming to a sort of stop. So we did see that, but other reports are suggesting that maybe this isn't slowing down or peaking. We saw the PPI, which is Producer Price Index. That's the price that businesses pay for goods. That hit an all-time record high when we got the report in April for March. So that's continued to rise higher. As we know, when inflation is high, businesses pass those costs on to consumers. And will that continue? And will that continue to drive consumer prices higher? Also, housing reports. We saw a number of those showing that prices for houses are still rising at that 15 to 20% pace that they were rising at last year. That's not going to suggest that housing prices will cool off or that rent prices will cool off. Shelter, a big component of inflation. So again, we've got this Fed report, and we're going to hear from the Fed on Wednesday. We're going to hear from Chair Powell on Wednesday. We're going to get their rate decision, and that's obviously going to move the market. Then on Friday, we get the jobs report. Also, that consumer credit report coming out on Friday. Be sure to look for that. The March increase in consumer credit is expected to be very small. Last month, or when we saw the report from February, it was $42 billion increased consumer credit, expecting just about $2 billion or $0.02 billion increase this month, which would suggest that spending in February was just pulled forward. If that happens, then it's likely, everyone can calm down. But if we see another big increase in consumer credit, that could be worrisome. So I want to thank you guys again for tuning in. We are going to wrap things up here on Market Takes. I am Dion Rabouin, markets reporter at the Wall Street Journal. Again, this week, look out for that jobs report on Friday, the Fed meeting on Wednesday that starts Tuesday, will end Wednesday. That's going to move markets a lot, but don't sleep on that G19 consumer credit report on Friday. Week's not over after we get the jobs report, so be sure and stay on your toes for that. Look, I want to thank you guys all for being a part of my live stream, for joining me today. We will do this again next Monday, and we're going to keep doing it every week as long as you guys keep tuning in. So I appreciate that. Like I said, could have been anywhere in the world, but you're here with me, and I hope you'll be with me again next week on Monday. I'll see you around.